So the Fed shocked everybody on Wednesday. See, it was a shock because everybody was expecting maybe more of a hawkish stance, which means they were going to be more on the defensive to raise rates again. But this side of the message said, hey, we really have reached where we need to go rate rise, and now we're going to be looking at cuts. Markets went bananas. You got every mortgage lender, real estate person, anybody that is connected to the housing market, they're going bananas. Stock market is going bananas. If you've been looking for a job, you're excited because you know by rate cuts means slowly, and as we transition to next year, the plan is that the economy should get better as far as jobs, as far as housing, as far as everything that you've been struggling with. And so that makes the argument for everything that happened this year, oh, we'll never be able to afford a house, which I said it's a temporary measure, but nonetheless, I'll never be able to afford a house. Now that brings that back into question. What can you expect should this happen? Now, keep in mind, before I go into some of the things that you would expect to happen this year, I want you to understand that, realize this is a forecast, and this is what they think may happen. And look at the forecast of what they thought may happen last December. Last December 2022, they thought we would be into a recession. That didn't occur. They thought we would hit huge bumps in the road and it would put more downward pressure on the economy. That necessarily didn't happen. And all of a sudden, more and more people are entertaining this idea of bringing down inflation and while keeping what seems to be a strong labor market under 4% intact, which defines a soft landing, which has never happened before. Nonetheless, we're not there yet. But let's just play this out. Should rate cuts come into effect, and mortgage rates have already started to dip down a little bit, but should rate cuts come into effect, what can you expect? Well, number one, that great high yield savings account yield you've been getting, those 5% that you've been seeing on CDs and savings accounts, yeah, that's going to start to decrease. Your mortgage rates will start to decrease, which is good, right? Because now more people can afford to buy a home. But as more people start to afford buying a home, the prices will increase. Just think about that for a second. The other thing about this rate piece is your car loans. All those people who are upside down. So if you have a 6, 7, 8% car loan, and that's with good credit, as these rates come down, refinancing will be available. The same thing of mortgage loan, the same thing of any loan. When you bought at a high price, you can now look to refinance. But how will you make money? That's where the stock market is going to become more of an option, because all this year it's really been optimal to have your money sitting in cash. Like 5 point something to be said of 5.1 trillion dollars sitting in cash. I say all this to say these are the things you can expect, because that's what normally happens in the economy. The motivation is to get you investing your money into the market. So even if it sits in cash for a year, well, you're not going to build wealth on 5% in a year. You need to be investing in index funds. You need to be investing for the long term. The point of all this, if you're in the labor market, you may still see cuts as they're still right sizing and people are trying to get it right. New roles will be coming available, but now less pressure on hiring and less walls of hiring should be there. The point of all this is all the things that you struggle with this year should start to improve. The one thing that you have struggled with that hasn't quite found a solution was pricing. See, inflation has come down, but the prices are still high. Pricing has been a huge instant because that's what you pay, and that's what's putting the real pressure on people's pockets. Pricing still hasn't been figured out. But as wages improve and jobs improve, the idea is that you will have more income to support, and more real income incomes will go up higher than the prices that are elevated. It's a very, very interesting time. And you can be excited, and it's good news to hear that the Fed is not looking to put more pressure. But the one thing I want you to take in consideration is whether you're looking at the Fed meeting, whether you're looking at all these YouTube videos, TikTok videos, whatever you're watching, understand, take it 1 month at a time. Wait and see. Because with anything, they're taking a lot of data, a lot of things in consideration, but ultimately, time will tell if they're correct. Because right now, everyone's acting and saying this is going to happen. It's all a forecast. We're not in 2024 and we don't know what may occur. Think about that. It's a great meeting. Shows a positive direction that will grow the economy and you will start to feel better with your finances should all that play out. If it doesn't, be prepared for the worst because we're still not out the woods yet.